Good afternoon, everyone. Welcome to today's stream. My name is Stock Darts, and we're going to do what we do on every Wednesday afternoon. We're going to go ahead and take a look at the four major markets. We're going to look at the S&P 500, the NASDAQ Composite, the Dow Jones, and the Russell 2000. Once we finish looking at the markets, we'll take a quick look at the U.S. dollar. We'll look at gold, silver, just see how far they're exploding today, and then take a quick look at the price of oil. Once we finish that, we will take a look at any chart requests anyone in the chat might have. If you're watching a recording of this, you can always ask me for a chart request if you want on Twitter. Just follow me at StockDarts and message me, and I'd be more than happy to give you my take on whatever chart it is you're looking at. If you like what you see here today, you can always follow for more content at Twitter, at StockDarts, YouTube StockDarts, or you could go visit patreon.com/StockDarts, where I post weekly blog content, including trade ideas, watch lists, and reposts of these Wednesday market reviews. Let's go ahead and get started. First thing we're going to do is take a look at the S&P 500. Last week was a big week for the markets. We had an FOMC meeting last Wednesday, and then on Thursday we had Facebook, Amazon, Apple, and Google all report earnings, and that was a lot of potential catalysts for movement in the markets. And looks like the overwhelming response for the market was we want to go higher. Now, the market hasn't really exploded upwards, but considering that was a point of contention where the market could go one way or the other, in the end what ended up happening was obviously resolution to the upside, as we've seen over the last few days. Now, interestingly enough, we didn't really get the clarity that I was looking for. I was expecting a pretty decisive move with the S&P 500 challenging all-time highs, and while it's on its way to doing that, it quite hasn't really reached that level yet. As we can see, it came within pennies today of filling a pretty important gap from back in February, right when the coronavirus drop began, and we're very close to doing that today. And of course, that's the next step in this process of the S&P 500 trying to join the NASDAQ Composite in printing new all-time highs and trying to move forward and past the beginning of this year. The question now is going to be, once we fill this gap, are we going to kind of continue unimpeded right back to those all-time highs, or do we need to spend more time consolidating and maybe come back? As you can see, price action is getting a little tired. You can tell with the volume declining as we sort of come up and the candles getting kind of small. We get these tiny little floating dojis as we come upwards, and we begin to print yet another rising wedge. Right, and so this is what I think is a nice picture of what declining momentum looks like, right? Or fading momentum. Now, this of course doesn't necessarily mean that it's a top, right? Because as you can see, we have other rising wedges that have printed, and what it becomes is that it's fading short-term momentum, not necessarily fading long-term momentum. And so what we're happening here is we're starting to lose a little bit of that upwards momentum we picked up last week, and we might have to come back and test the 20-pair moving average, or even all the way back to 320. But overall, this is still, at the moment, a bullish stance on the S&P 500. We're going to need to see a little bit more damage done before we could turn around and say it's negative. Last week, like I said, on Wednesday, we were actually at a point where the market could have gone in either direction. Depending on what happened with FOMC, depending on what happened with those four major earnings reports, there was a pretty decent chance that the market was going to break down and lose 320 and start coming back down and testing some of these moving averages. After all of that, you'll notice we don't really have any catalysts right now as far as predictable news in order to move the market in one direction or the other, which means that the market's going to move off of technicals for the most part and really just sort of respect the trend lines and the moving averages and kind of go along the same trajectory it's been going on. We would need some more news to come out in order to try to influence it in one direction or the other once it starts to stall out again. So for now, we can basically expect the momentum to continue to persist in an upwards fashion, which means if we do pull back, we should expect 320 to hold a support. We should expect possibly even the moving average, the 20-pair moving average, to hold a support. As you can see, the moving averages have been steadily climbing upwards, showing the beginnings of, well, not the beginnings, basically the continuation of what has been a strong trend throughout the year after we kind of bottomed out in March and April. And now that we've crossed the 200-pair moving average and started to make our way back upwards, again, it's showing basically that the market wants to put this behind us in the rearview mirror. And even though it doesn't feel like that, And it's clear that as far as our economy is concerned, as far as our society and the way we're behaving, we haven't really left the corona pandemic behind. We're still in the middle of it. We're still dealing with business closures and with a rise in infections across the nation, really. But the market is kind of looking forward, and possibly because it's being propped up by so much stimulus injected into it, it's kind of looking at it in the rearview mirror, saying, "Well, yeah, but it's a known quantity." And really, what scares the market is unknown quantities, right? And I think at this point, the market has kind of figured out exactly what the impact has been, and it's under the assumption that we can keep going upwards. Now, I still think there's a very big disparity between two types of stocks in this market, and I think that continues to play out, and that's these tech names that are very, very well insulated from what's been happening with our economy, and then other names that are being impacted a little bit more severely because they need people to go out and either use their products or use their services, and so we have this gap between stocks that are basically at all-time highs and performing as in a situation where everything is kind of lining up for them to keep doing well, and we have other stocks that are just not really being able to keep up. And so despite the fact that the overall broad market index is doing well, underneath the surface you'll see that there are still different types of stocks that are doing well and stocks that are not. And so rather than blindly buying and blindly kind of following this bull thesis, we have to be smart enough to understand where the money is, how it rotates back and forth between those strong stocks and the weaker stocks, and make sure we don't get married to those weaker stocks, thinking that just because they're down so much that they'll eventually recover. Because things like airlines, if we take a quick look at something like Boeing, or take a look at stuff like Delta. These stocks are going to take a while to come back, right? And it's not to say that they're not going to have bullish moves or they're not going to have bullish charts that can give us trading opportunities. But if you look at where they go, a lot of traders will be like, well, this is at $26 and it's normally a $60 stock. We've got $40 of upside. We should go ahead and try to trade this. And I'd say it's fine if you want to trade it for short-term moves, but if you think that it's going to get back to 60 anytime soon, I think that you're being a little bit optimistic, because the truth of the matter is it's still going to take a long time for the economy to reach a point where these stocks can get back to where they were just at the start of this year. We're still having a lot of restrictions across the board with travel, with business, and emotionally a lot of people just aren't ready to go back and start traveling and put themselves trapped in an airplane for several hours with other people. So it's going to take a long time for businesses like this, or maybe movie theaters like AMC, to make their way back to where they were before. Now, again, like I said, that doesn't mean they can't set up charts or set up for moves that give them opportunities to climb upwards. You take a look at AMC, for instance. It's actually setting up a possible trade from $4 to maybe $6 or $7. But if you're thinking of it getting back to where it was last year or the year before, it's a long way to go, and I think it's going to take a lot of improvement in our economy before these types of stocks are going to get back to those levels. And you contrast that, actually we'll leave it in the weekly for a second, you contrast that with stuff like Netflix, right, or Amazon, and as you can see, they've already left behind the price action from the last couple of years and the price action even earlier this year, because they're benefiting from us staying at home or working from home or shopping from home or finding all of our entertainment options from home. So companies like that, like Amazon, like Zoom, they're trading at all-time highs and they're moving upwards because they're benefiting from this. And then meanwhile you have other stocks that are not. So it's important when we look at something like the market indices and we try to figure out, hey Sam, good to see you in here. It's been a while since we get to catch up. So when you take a look at the market, right, you don't want to get caught up and think that every stock is doing well. You have to understand that at the moment there's a pretty big dichotomy here, and a pretty big discrepancy between certain stocks that are going to do well and certain stocks that are not. And it's important to understand that, and not to just look at the S&P and say, well, the S&P's at highs, everything's going up and everything's doing well. That's not actually the case. There's a lot of stuff that's doing well, but there's a lot of stuff that's still struggling, and even though in short-term terms, relatively speaking, they might do well this week, in the long term, if you really look at where they are, they're still trading um, at a huge discount from what they normally trade at. And it's not necessarily a discount you're going to recoup anytime soon. So that's important when we look at these markets and we figure that out. Understand that there's underneath the surface there are still the haves and the have-nots as far as this market's concerned. And I think that sometimes this market, the ETFs and the indices, they're not giving us a clear picture of just what is going on underneath the surface, because there are a lot of companies that are still struggling to make back some of the value that they lost this year. Now that being said, as a whole, obviously as an aggregate, the market's doing well, and a lot of that is probably due to stimulus. But we don't care about that, right? What we care about is price action. We care about what we can get from it. Whether you think that the market being up is a phony move because of stimulus, or because the market is using smoke and mirrors, or whether you think this is a real move, it doesn't make a difference. If you own the ETF SPY in your bank account or in your trading account, or your retirement account, well, you're up, right? And that's real money you could put into your account. And vice versa, if you think that this is a fake move and you didn't buy anything, well, that's an opportunity you've lost to increase your overall wealth. So it's important to keep in mind that price action is what pays, especially in anyone that follows me knows I basically trade off technical analysis, and we try to follow market psychology, and we try to follow what the market is doing and the price action. And basically that means that sometimes you have to ignore the fundamentals or not let them overly influence the way you're trading. For instance, even myself emotionally, I've been looking at this market as one that's kind of heavy, and I feel like we're kind of setting up for a possible retracement or price correction. But that hasn't stopped me from trading to the long side, because I'm still going to follow what the price action tells me, not necessarily what my heart tells me, or what my overall bias is. I still feel like we have a lot of overhead resistance that we are challenging, and my expectation is that at some point we will eventually face too much distribution or too much supply and not be able to overcome it. And when that happens, we will finally get a correction. Now, I'm not expecting a correction down to lows, but I do think that we need to sort of stay range bound, at least on the S&P 500 or the Dow Jones, maybe obviously not the NASDAQ, and maybe spend a little bit more time getting this market in better condition, or the economy in better condition, before we continue rallying. But I'm still going to listen to the market, not necessarily what my thoughts are. And the market right now is still probing for highs. It's still trying to figure out where the ceiling is, and it hasn't found the ceiling. And as long as it hasn't found a ceiling, it's our job to kind of follow the momentum and trade that momentum in the proper direction. And so that's what we're doing. These last couple of weeks, I've been able to weather the storm a little bit by trading earnings and taking advantage of that, while our directional trades are limited. But for the most part, we still want to go ahead and try to trade this market upwards. Now, the problem we have right now, of course, is we have 1, 2, 3, 4, 5, 6 green candles in a row. So at this point, in the short term, it's getting a little bit more difficult to trade in the to the long side, because it's starting to get a little overbought. Risk reward's not in our favor, right? We've got, like I said, we're pennies away from filling a gap. We're not that far away from all-time highs. So our upside is pretty limited, and while our downside is actually, there's plenty of downside even to our normal levels of our short-term levels of support. And if we lose those levels, there's a lot more room to the downside before we find more substantial levels of support. So at the moment, the risk reward's really not in favor of getting too aggressive to the long side. So what we want to do here is we want to take our shots in stocks that have not yet manifested this pattern and are still trading at support, or we want to wait for a drop and then buy at the next level of support that we consider to be good buy the dip opportunity. Now, if you're anticipating the market pulling back like I am right now, that doesn't mean I want to short it, because I understand that right now there's a lot of demand that is wrapped up into this market, and that means that even if you're anticipating a drop in price, you don't really want to short it, because it's going to be a very difficult trade to take. A lot of times what happens is, you can see we had this last rising wedge, and very often when you have a rising wedge, you typically have a quick 2 or 3 day move down, and then it's followed by a bounce. But as you can see in this case, it was 2 days tops, because there were so many buyers waiting to step up and get advantage of a market that they feel like they're missing out on, right? And that's a that's a more, almost as a lot of times, a much more insidious fear in the market is the fear of missing out, not necessarily the fear of loss. And I think that affects traders a lot more and forces this sort of pattern where you have these rising wedges, because traders are fearful of missing out on this bounce, and they're fearful of missing out on the next big move. Uh, and so they're more likely and more inclined to chase this price action upwards. And then those that are even somewhat, just a little patient, just buy it immediately off of the first drop instead of waiting for better levels of support. And so you get these patterns where you get these rising wedges and then these quick moves up. And we looked at this last week, but as you can see, that pattern has played out before. If you look at the pattern that we had going from last October all the way up to the start of this year, right before we had the coronavirus really start to push the market downwards, we had three rising wedges, right? We had a nice rising wedge here, then we had another one into the holidays and through, and then we had the last one right up into the start of the year. So at that point, there were a lot of traders that, again, were fearful of missing out, and that pattern was playing out again where traders were just chasing the price action upwards, and those that were even moderately patient would just wait for a few day drop, and then they'd jump in, and then it would just keep repeating itself over and over and over again. You could probably put little rising wedges inside of a lot of these bigger rising wedges. And so the price action was very similar and very persistently upwards. And we're starting to get that again. Now, not quite the same pattern. And I don't think, because of the way the price action set up last year, it seemed to be a little bit more sustainable to keep climbing upwards for several months at a time. I don't know that we have that kind of momentum this time, because we've already kind of climbed upwards for several months at a time. But like I said, until we see a change in character, until we see this change's trajectory, we have to assume that the pattern's going to persist in the same direction. So that's what we're looking at with the S&P 500 now. We've already mentioned some key levels, but let's just kind of rehash them. To the upside, we are at a very, very important level right now, which is this gap. We're likely going to fill it. Like I said, we came pennies short of filling it today, and we're likely going to fill it in the afternoon, if not tomorrow. Now, the question will be, when we fill that, are we going to push our way up and test all-time highs, or will we falter and come right back down and test the 20-pair moving average? And I think that'll be kind of the first real level. So to the upside, we have 332 and 338 as key levels of resistance. And then support, we have from 322 to about 320 is the first level, and likely the level that holds. So if we do drop, I expect that level to hold, at least initially, and I would expect the bounce to come at that point. Now, whether the bounce is enough to push us to right back through the gap is still to be determined, but I'd expect that to be a good level to buy the dip as we come back and approach either the 20 period or just below that at this 320 level. At that point, the 50 will have caught up probably to price action and will likely give us another level of potential support. If for whatever reason we get news that wants to push the market further downward, then we come back down to the 200 and likely down to this 299 to 295 area. And that is major support, and I would not expect that to be breached anytime soon. Even if we have a pretty quick move to the downside, I'd expect this level to hold. However, in the short term, I don't think we even lose 320 right now. So that's the key level that I'm watching for a short-term buy the dip opportunity. And that's the level that I would say is probably going to hold from here to next Wednesday. If we lost that level, like I said, then there's a decent chance that we're going to have to make our way back towards the 200. But that'd be a pretty quick move down through the 20, through the 50. So there would have to probably be some kind of news to push the market and to scare it into that kind of a drop. Like I said, right now, there aren't any potential catalysts really in the way. We have most of the major earnings already through. You'll notice even last night we had Disney report earnings, right? And they had a net loss of $4 billion. And the market still somehow interpreted it as good news because they expected worse, right? And so Disney was up basically 10% today, despite losing 4 point something billion. And so we're in a market right now where, people expect bad news. And as long as it's not terrible news, then they think it's priced in, and they consider it as kind of like a win, quote unquote. So it's going to take a lot to scare the market right now. I do think short term that we need to fade, and I think that we need to kind of come back and kind of shake out some of the weaker hands that keep chasing the price action upwards. But clearly the market still is looking upwards and is still looking for a ceiling. And until we find that ceiling, expect this price pattern to persist. Now, You'll notice as we move to the NASDAQ that the NASDAQ has kind of already done that. What the S&P 500 is going through, the NASDAQ did a while ago, right? You look at the gap that was created in February. The NASDAQ already came up and challenged that, broke through it, came up, tested all-time highs, retested, and then broke out. And at this point, what they just did is pretty impressive as well, because what we had here was we had a double top. Right? Let's change that back to white. So we had a double top, and it was a confirmed double top. We came up, tested 270, failed, came back down, came up, tested 270, failed, and then actually broke down. And that ended up being a false move. And typically, when you have a pattern like this, and you have a false breakdown, that usually leads to a pretty strong move in the opposite direction. And we kind of got that over the course of the end of last week, where we finally broke out. And you'll see it was a quick 3-day move right back to highs. And with yesterday and today's price action as we start a new week, the NASDAQ is in new all-time highs and is trying to make its way through this double top. So, it's bullish. Everything about this is bullish. And I don't think that this is a very particularly impressive 3-day move as we try to break out. But overall, if you really look at it in totality, what it's doing, it's negating what was a topping formation and trying to make its way back through it. So even if we falter here and come right back into that range, it's given us enough momentum to at least kind of conclude that this was not a top and this was just a consolidation range, which means that even if we come all the way back down to 255 or even a little bit below it down to the 252 area, we've established this as an area that the bulls are willing to defend and willing to go ahead and go long. So overall, this again is a bullish development from what was potentially a bearish warning. And so until we see this come back down and maybe we get some kind of a triple top or a head and shoulders or something that starts to form to try to make this a bearish pattern again, we have to assume that, again, this is a bullish chart, because right now it has given us a bullish development to say the bulls want to continue trying to probe upwards. Now, again, this is not an impressive breakout at the moment. What is impressive is the fact that we negated the breakdown and came all the way back up. We need a little bit more to be able to leave this range behind and say that we're stair-stepping upwards. And we'll see what happens in the next over the course of the next few days. But even if we pull back now, we have the 20 period again holding the support. We've got these nice train tracks between the 20 and the 50 period moving average showing us the strong trend that's in place. And until we see a deterioration of this, we have to assume that the trend is still going to be strong and continue kind of persisting upwards. We need to see these moving averages start to turn sideways. We need to see the price action start to cut through these moving averages before we can assume that this trend is starting to slow down or is getting ready to conclude and give us a more stable base. Now, keep in mind again, just because this trend, whenever this trend does end, that doesn't mean that it's a top and we're going to make our way right back down. It could be that the trend shifts into neutral and we just trade sideways and build out a new base of consolidation. Again, look at how far we are from the last all-time highs we had earlier this year. There's a lot of room for the NASDAQ to drop and still basically be in a good place. Now, keep in mind, like I said, look at the earnings from these 4 FANG stocks that reported. Facebook had big earnings. They were able to break right through whatever the expected range, and were basically blew right through what the options market was anticipating. And they've kind of come back and they're retesting, but overall this is still bullish despite the fact that they faded for 4 days, because they're just retesting recent highs and are basically changing resistance into support. We've got Amazon. Amazon was kind of neutral. It did have good earnings and it came up towards its highs, but it kind of stayed stuck in a range. And this was actually a good earnings trade for anyone that follows me on Patreon. This one worked out very well for us because we expected it to stay range bound within this white box, and it did so, which gave us max profit. However, overall, it's still kind of trading near the top of its range. It's still doing well. Apple, of course, had blowout earnings and gapped up significantly higher and continued climbing upwards. And so if you look at these FANG stocks, they're part of the reason why the Qs are doing so well. And of course, the only one of the 4 that really didn't have good earnings was Google. And it didn't really break down. It just kind of came back down, and it's kind of probing below its recent support level. And this one again, you've got a potential double top, and it's breaking down, which would signify kind of a reversal in trend. But it's doing a lot like the Qs did, where it's kind of resisting that breakdown. And if it makes its way back up above 1490 and back into that range, then that again will have probably proven to be a false breakdown and will likely lead to a move back up towards the middle, if not the top of that range. So overall, these tech names are holding up, and of course that's what's leading to the Qs basically being where it is. Because again, the Nasdaq Composite and the Qs in particular, the Qs ETF, are very heavily weighted in the FANG stocks, and the fact that they're doing so well is going to lead to this doing well. However, there are again a lot of other tech names that have benefited, like Zoom and Citrix, from people working at home. And so a lot of these companies that benefit from that, a lot of these cloud services, they're going to do well, and they're going to continue to keep the Nasdaq propped up. So, we were discussing earlier this disparity between the haves and the have-nots in the market. The Qs is where the haves are, and so if you are still kind of scanning for stocks that you like and stocks you want to trust, you still want to spend more of your time in tech names and the Qs in particular. Now, you don't want to chase the price action. You still want to buy them at dips. You still want to have good risk to reward ratio, and you want to be disciplined about how you trade them. But this is the area that you want to look at if you're really focused on strength and not trying to take chances with your portfolios. Now, in pretty stark contrast to what we just saw with the Nasdaq, we have the Dow Jones. And as you can see, the Dow Jones, while it has been bullish over the last week, actually possibly even more bullish than what the S&P 500 and the Nasdaq are doing as it plays catch-up, long term, it's still struggling, right? You take a look at that gap that the S&P 500 is trying to fill and the Nasdaq left behind a long time ago. We're very far away from that in the Dow. Nowhere near filling that gap. We're actually not even at this red level, which is now support for the S&P 500 and the Qs. We actually haven't even come up to that, anywhere near the bottom of that gap. So, relatively speaking, the Dow Jones is still weaker. And again, the Dow Jones is going to have some components that are struggling with this market, stuff like Boeing, maybe Caterpillar, which is another name that benefits from industrial stuff, and not quite as bad as Boeing, but still kind of struggling to make its way back to all-time highs. And so, the Dow Jones has certain areas that are going to still be struggling, and it's going to kind of keep it behind a little bit. But overall, it's still mimicking the same pattern as the S&P 500 and the Qs, just at a little bit of a lower level. Overall, this is still a nice bullish development. We had the surge upwards in June. We pulled back. We tested support 2 or 3 times, and then we broke that trend line, right? And as we started making our way upwards, again, notice the bullish formation of the moving averages, trying to copy what the Nasdaq and the S&P 500 are doing. We're starting to get that parallel 20 and 50 curling upwards, and they quite haven't achieved the same trajectory, but they're starting to, and they're crossing over the 200. So we have what could be the start of a second trend. And you might say, well, the Dow Jones has been trending upwards all year. But if you really think about it, it's actually been range bound for a while now, right? So despite the fact that we've been climbing, and we have been steadily climbing, right? If you just go ahead and pull a trend line, the market has been climbing pretty steadily for a while. But if you look at it from a different perspective, let's get rid of that trend line, and you just look at what's happened over from June to now, well, we've basically been trading sideways, right? But we have signs of a possibility of the trend starting to make its new leg up, right? And you can see with the moving averages, the price action hasn't really confirmed that. And there's a case that maybe this doesn't really transpire all the way if the other indices tire out. But for now, what we have here again is despite what we may feel as a market that needs to pull back, we have signs of a budding trend coming upwards again, and that would lead to the Dow Jones trying to break through its recent range, which means pass through this 276 level and up and start challenging this area around 289 to 284. Now again, the one thing I want to point out is that there is a lot of overhead resistance, and I think that's one of the things that has kept me from being fully gung-ho about trading to the long side over the last couple of months, is that we've been really dealing with a lot of overhead resistance, and once the Nasdaq was able to deal with it, and now the S&P 500 is starting to deal with it, But once those two deal with it, then we still have to have the Dow Jones deal with it, and then we're finally after that we're going to have IWM try to deal with it. So there's still a lot of potential walls that we need to break through across the board in order to have all four indices at all-time highs and rallying upwards. Uh, However, until we finally see how that concludes, we just have to keep trading the price action as we always do. And for now, again, this is all bullish. And this is all leading up to those tests. And when we get to those tests, we see how the market responds. And from there, we can go ahead and reassess where we are and where we expect the market to go. But at the moment, everything here is pointing towards a test of those levels. You'll notice this is pretty different, right? The S&P 500 looks like it's tired and looks like it wants to pull back. The Dow Jones looks like it's accelerating and trying to make its way upwards, right? So there is a chance that the S&P 500 and the Nasdaq drift upwards a little, while the Dow and IWM, try to carry the mantle and try to carry us upwards in the short term. And if that's the case, then we can expect another day or two of rallying up to these recent highs. Other than that, there's really not much more I want to say about the Dow. I think in a matter of, generally speaking, the price action is the same. It's just at a lower level. So we're still looking to make our way upwards and test these recent highs. The S&P 500 is looking to test all-time highs. And if we falter here, we're going to come back and test the moving averages just like the other two indices. And if we falter below that, then we have major support down here, 249. And I don't really expect us to get there from here to next week, or even from here probably to the end of the month at the very least. But we'll see what happens. But for now, I'm expecting us to kind of probe upwards a little bit more and then come back and have a shallow test and continue trying to probe upwards until we get more firm rejection from the price action, which we haven't really seen yet. And then finally, the last one we want to look at is IWM. And again, in the short term, IWM doing, the last few days, nice, 1%, just like the Dow, while the others are at half or 0.2%. So we're getting a little bit of catch-up, and we're getting a little bit of money rotating towards weaker stocks. Now, I've noticed this happen a few times now, where the stronger names get tired, and then money quickly rotates to the weaker stocks. Usually after that, we get a pullback, right? So I think we're getting close to a pullback. But for now, we've got the same pattern as the Dow Jones, right? We're coming up and testing recent highs. You can see the the IWM and Russell 2000, actually almost there, right? But still got a ways to go to get to this level up here around 158, and that gap from early February, still have a ways to go from there. Now, with IWM, you have even more to do because it was already relatively weak even at the start of this year. All-time highs are still were still formed last year, not this year. So IWM still has a lot of catch-up to do, but it has made its way back up. Nice trend upwards for the most part. Just like the Dow Jones, it has traded sideways for a good portion of the year. However, the trend for the most part has still been pretty much intact. As you can see, we've kind of started to violate it a little, seen a little bit of slowdown in price action, but I think overall it's doing pretty well and has done, really it's done its job, which at the moment is to not be the drag or the anchor that holds the other indices back, which is really what IWM has done for the last few years. It's just been kind of the check that keeps the other indices from rallying too strongly. And that's kind of what it's doing again. So again, this is another area of the have-nots where a lot of small caps are struggling because a lot of traders are still avoiding risk to a certain extent and not willing to take too strong of a position in a lot of these more volatile assets. Now, the analysis is the same as the Dow Jones for the most part. If we can push through these recent levels of resistance, we can come up and start challenging the lower level of support from earlier this year, which would be a pretty big win for the small caps. Then from there, we're not that far away from trying to test all-time highs. Again, I expect to find major resistance, and I expect the price action at some point to be rebuffed pretty firmly. But until we see that, we'll just keep watching it climb upwards and keep testing till we find that rejection and we find enough sellers to push the market back down. And we have not found that yet, and until we find that, we just have to, again, assume that the market wants to continue going upwards. Now, again, there's a lot of room to the downside. However, we've got all the moving averages, and again, just like the Dow Jones, they're starting to cross, the 20 and the 50 are starting to cross through the 200, which is a pretty good sign of an emerging trend. And if we break through them, we're going to have to break through three pretty important moving averages. And if we do so, then yes, we have a drop all the way down to 135 that's possible. That should be a strong level of support, however, even if we do violate all those moving averages. But more likely than not, on the initial drop, whenever we get it, um, these moving averages should support price. If not one, then at least another one. And if not that, at some, hopefully the last one. So overall, if we look at the market as an aggregate, we look at the four major market ETFs, you can see that despite the fact that it feels like we should be dropping at some point soon, we just keep testing these levels of resistance, the market continues to persist upwards, and it continues to show a bullishness that maybe we're not really ready for. Hopefully you guys have been taking advantage of it. Those of you that follow me on Patreon, you know that we've still been focusing on the long side, and for the most part have had good trades pretty much every week. Even the weeks that we don't have strong directional opportunities, we've been able to take advantage of it with really good earnings trades. And the one thing I could, I don't want to really, I can't stress enough is trying to call a top here and trying to short the market is not really a good idea. Like I said, at some point the market will drop again, but you don't want to get into this habit of trying to guess it because it's a bad habit to get into, because even if you're right, you could still be wrong. It could be that the market drops for just a couple of days and then it bounces and shakes you out and then it drops again and you're out of the trade. It could be that you wait, you're short for 2 or 3 months at a time and you lose so much trying to guess short early that by the time it works, you're just making back whatever you lost in the first place, if you can even do that. There will be signs of an erosion in price action, and that's when you start to look at maybe shorting. I don't think there's enough signs right now telling us that the market is losing enough momentum, or that we're getting a shift in trend where we could think about that. Like I said, we had a potential shift in trend with the Qs, but that lasted one day, and then we just went right back through there and back to the other side. So until we see more stuff like this that actually goes in the right direction and doesn't end up being a false move, we really shouldn't be trading to the short side or fading the market. We should just be waiting to take advantage of the market as long as we have good setups that give us what we're looking for. All right, so that's basically my thoughts on the market right now. We'll take a quick look at the U.S. dollar, gold, silver. Those of you that are in here, if you have a chart you want me to look at, feel free to type it into the chat. Let me know if it's a name that you're long or short, or maybe a name that you're looking to enter, and I'll give you whatever my thoughts are on it. Let's take a quick look. Here's the U.S. dollar. U.S. dollar has really struggled, and I thought maybe with last week with FOMC, we'd finally get a relief bounce on it, and then maybe we had to sell the news where the market just dropped into, the U.S. dollar dropped into the Fed announcement. And we got that for 2 days, and then we just turned right back around, and the dollar just continues to just get hammered. If we look at the euro and see what it's doing versus the dollar, you can see the euro has rallied strongly, and even after that couple-day drop after the Fed statement, we've turned around this week, and the euro has again rallied strongly back against the U.S. dollar. The U.S. dollar has really struggled, and this is a big reason why gold and silver have been up so strongly. It's partly the reason why the market is doing so well. And I don't know how much longer this can really persist. But for now, again, it's a strong move, and everything is pointing to the U.S. dollar still struggling. If we look at the U.S. dollar versus the Canadian, you can see again a breakdown. It tried to bounce and then it faltered, and it just caved in. And again, is maybe trying to set up another bounce now, but I don't know that we found enough capitulation here yet to have a decisive bottom. Just like I don't think we found enough here on the euro to say that we have a decisive top. It's not anywhere near that yet. And in the one area where the U.S. dollar maybe isn't quite as bad as the yen, but even that one, it kind of tried to get a relief bounce, and it's even faded that over the last couple of days. And it's still struggling below key levels of support here. So the U.S. dollar has really struggled. Sam, not sure if you're still trading Forex or if you've just moved on to stocks again. But going against the U.S. dollar has been a pretty strong trade over the last few months. and it doesn't look like it's over yet. And so, it will be interesting to see just how far down the U.S. dollar needs to go before it finally finds a new floor from which it could kind of start to bounce against some of these currencies. And that, of course, has led to these massive surges in gold and silver. You look at gold, you look at what it's done just the last 2 days. It's a huge move, going from 185, the GLD ETF from 185 all the way to 191. We left this area behind, this gap, had a 4-day momentum kind of bull flag, and then just broke out. We look at the spot price of gold, you can see it's basically gone all the way up over 2,000, right? And we had this big surge from 18 to 2,000 just over the course of maybe 2 or 3 weeks. And so, gold continues to rally. Now, it's difficult to go ahead and recommend the long here. And I'm not ashamed to admit it. I've missed all of this. I wasn't really comfortable with a lot of the gold patterns. And there's a huge move that, a huge opportunity missed. But, it's no big deal. That's one thing you have to learn as a trader is you're not going to catch everything, right? And so this is one of those. We've looked at it every week, and I have noted that it's been pretty bullish. But I personally have not traded it and have missed out on quite a bit. However, the reason I'm saying that is because I want you to realize I have no interest whatsoever in trying to chase this. Despite the fact that I missed a strong move from 170 all the way to 191, you have to sometimes tip your hat. If you don't get to trade this, you tip your hat and you say, great move. I'll wait for a consolidation. I'll wait for a pattern that I trust, and then I'll go ahead and try to take advantage of it. And it's going to be the same thing with silver. Huge breakout and a big move over the last couple of days. However, if you saw this and you didn't get to trade it, just like I said, tip your hat and say, great job, nice move. I'm not going to try to short it. And if I want to play long, I'm going to have to wait for a pattern to develop that I like, which is probably going to take a while based off of this price action, right? Because it's going to have to come back to support, and it's going to have to come back to support in a way that you could trust it, not in a quick, 2-day drop where it becomes a pattern that you don't really trust because that's a big fade off of a big move, right? So now if you're in these, I'm hoping that you've taken some profits along the way, and then you just keep trailing up your stop on a portion of your trade as it continues to go upwards. There's been a lot of opportunities here to scale out and to lock in profits throughout all of this. And so, these have been strong moves. At some point, obviously, they're going to have to consolidate and pull back, probably very soon. And when that happens, maybe that gives traders opportunities to get back in. Big volume spike on this as well. And then the last thing we're going to look at is oil. And unfortunately, we still have to kind of zoom out, or zoom in a little, to ignore that wick. And as you can see, oil has rallied, actually. And if we go to the 4-hour chart to get a clear look of it, you'll see that we've had a big move in oil and a big spike over the last couple of days. And it's interesting because we had this pattern, right? And we were looking at this last Wednesday, and it was obvious that oil had to go one direction or the other. It was reaching a point here where we had too many trends fighting, and there was going to be resolution. And as you can see, we had another false move, right? We had a breakdown, and it immediately found support, and then it kind of climbed right through that and has now made its way upwards. Now again, it's fading strongly today, so it looks like oil is still really struggling with this $40 to $42 range. The key now is, can it start to establish this as a support level instead of resistance level, right? So over the next couple of days, as it comes back and starts to test these levels, it's going to have to find support, and it's going to have to start trying to establish the price action above 42 and above 42.50 if possible, to show that this is indeed a false breakdown and that oil is ready to climb upwards and make its way back and hold and show that energy continues to be in more demand across the board, which again is a sign of an improving economy, if possible. All right, so that's oil, gold, silver. Obviously, this chart is going to be a while before we can ignore that wick from that 1 day of negative prices. And until then, I'm going to have to keep going into the shorter term look of it. Does anyone have any chart requests? We got about 15 minutes. If not, I can wrap it up already. I don't really have too many charts that I want to discuss at the moment. Most of my trades have been going on for the last couple of weeks. Like I said, we had a good trade on Amazon last week. that did really well for us as an earnings trade. We have stuff like Codex that has done really well for us, that has really broken out and really rallied nicely recently. We have several stocks, for those that follow me on Patreon or subscribers, that have done well for us. But as far as this week, the stocks are still setting up. And, to respect the people that actually pay for that, I'm going to wait until we get a little bit more of a move, one or a failure, to show you guys what we were looking at. All right, well, for those of you that maybe want to ask for, or shy, don't want to ask for your chart requests in public, you can always message me on Twitter. I'll be more than happy to give you a chart request through that means. Just like I said, anytime you guys have a chart, you have a question about, feel free to ask me. It's like I'm more than happy to help out. I really have no problem helping people. Sometimes people get turned off with Patreon, with the fact that they have a subscription on there, even though it's only $8 a month. Which I think is pretty cheap in order to get kind of a newsletter style information. But I'm more than willing to help people out for free, right? So if you ever have a question, just ask, and I'm more than happy to give you my thoughts on your chart. Sam, you're asking about AMD, everyone's favorite. Now, it's interesting because we've had discussion on our Discord about some long-term call buyers that have been extremely bullish on AMD, and we're talking like looking at next year's like $140 strike, right? And so there's a lot of crazy demand and a lot of, I think, kind of crazy optimism on AMD. Now, of course, they don't need it. AMD doesn't need to get to 140 for those guys to make money. They already have made money if, just based off the last 2-day move, because of course, with that long to go, the options price has appreciated, and they don't always have to hold it all the way to their strike. But AMD has had a lot of bullish options flow, and a lot of bullish momentum, as you can see. Strong move through their earnings, high volume, and a very, very bullish development on their chart. They are in the process of what I call a markup phase, right? They had as you can see, a very clear base. They spent a long time trading sideways, right? And they are now in the process of breaking out of that. And so this is a pattern that obviously persists through all equities, where you have these accumulation phases, right? And then eventually you have an imbalance where there's more buyers than sellers, and that's when you get these breakouts on high volumes. This is textbook. It never came back and retested, showing just how much momentum is in place right now. Now, the problem with something like this, of course, is at this point, if you traded this, you're happy. If you didn't trade this, there's not much you can do, right? If you are a short-term trader, then you could have traded these bull flags, right? There's been a few bull flags that have been worth trading. But not every bull flag has been tradable, right? So we have this. This was a pretty easy trade for those that were willing to take it. Obviously, in hindsight, it's easy to point these out. But, you got your bull flag, and then you have the breakout. And it was a very strong breakout. However, you have other times where it's not easy, right? So something like this, where you have a 2-day consolidation, and then you have a gap higher. And for a trader waiting to buy that, they never really got a chance. And then the last time really was over here, was the initial breakout. So, sometimes these moves are easy to trade. Sometimes they're very difficult to trade, especially when you have earnings coming up, right? Which makes it very difficult to go ahead and try to trade unless you are doing an earnings-specific type of a trade. It had a good earnings, and it's kind of resolved to the upside. I can't tell you why people love this and why they don't like Intel, but it's clear people do love this, right? And so now, this is one of those, again, where you have to wait. Once you have these markup phases, unless you're a very short-term momentum trader, you have to wait now for this markup phase to give you a consolidation that gives you an opportunity to enter. And the reason I say wait for a consolidation range is because you want to have good risk reward, right? You can't control a stock, whether a stock's going to go up or down. The only thing you can really control is what your potential risk is versus the type of reward that you are looking for. And in order to do that, you have to wait for a stock to get to a point that you find is a little bit easier to predict and gives you a little bit more of a stable entry. And at the moment, that's not really the case with AMD. So a lot like the gold and the silver charts,
You just say, nice move, AMD bulls, and I'll wait and watch. Now, Intel, on the other hand, of course, it had a poor earnings report, and they have gapped down. So you said you're not planning to go long AMD based on fundamentals. You like Intel. You like their PE ratio. And as you know, I don't pay attention to that stuff. So I'm not. That's not something that I would ever kind of go into. Um, so what I do is I look at the price action, right? And right now the price action obviously is not favorable. So what you want to do in something like this, if it's a stock that you like the fundamentals, and you want to buy at a discount, then you want to buy on moves down, right? And that's an important thing to keep in mind. Is when you're looking to enter something, especially if you're looking as a long term holding, you don't want to buy when it goes up. You want to buy when it goes down because you want to buy it at a discount because you expect to hold it for a long time. It's very different from trading, swing trading, where you're looking to hold for a short time. In which case, you're trying to trade strength and you're trying to buy um, momentum upwards. In this case, you're trying to buy something at a discount, which is understandable. And I'm assuming this is something you're looking at as a long-term hold, not as a swing trade. Um, so what we do is we go back and we look at the longer-term chart. And we try to figure out exactly what Intel has done. As you can see, Intel, again, a lot like AMD, was trading sideways for a long time, right? Now, you'll notice something important here, right? Which is it did break out, and it failed that breakout, and it came back into this range. So Intel was not ready to be a 55 to 60, $70 stock. Intel at this point is basically a 42 to $56 stock, which is what it's been since 2017, right? And it's right back to that level. So that's something that's important to keep in mind when you're doing what you're doing right now. When you're looking at fundamentals, and you should only look at fundamentals if you're looking at it as a long-term trade because they really don't have an impact on the chart in the short term. Um, Unless you're just trying to screen out stocks with bad fundamentals because you don't want to risk money on stocks that could have bad news, right? But like I said, I'm assuming in this case because you're looking at the fundamentals and the way you're analyzing it, that this is a long-term holding you're looking to get, right? So if that's the case, you look at it long-term, and you'll notice it's kind of in the middle of a longer-term broad range between about 42 and about 57. It's at 48, right? So you've got about 6 points of downside, and you have about 8 points of upside. So kind of in the middle. Um, it is finding support here. You can see that was a level of a lot of price action. It is the moving average on the weekly chart. So this is not a bad spot, but you'll notice there is potential downside till you get to really strong support down at 42, right? So that should be an important plan as far as the scaling in process, is understanding where your ultimate floor is, where you could trust the price action, right? So we can get rid of that rectangle for now. We can go back to the shorter term action. So you can see where it's finding some support here on the weekly chart. On the daily chart, it's just kind of floating, right? You can see we've got a couple of important levels here. We've got a major buy zone from March, right? This is when it bottomed out. All right, so that's where it bottomed out in March, which is important because that's where it bottomed out after the whole coronavirus drop, right? And we haven't hit there yet. We kind of came up to the middle of it, and we're coming up. But you'll notice there's another level here. That we are only now starting to come up into, right? That's going to be an important level for it to break through. You can see that's where it found support on the initial earnings gap. And then it clearly wasn't able to hold here, so it dropped down. So looking at it now, we have a picture of what Intel could do, right? So you say you're planning on holding for 12 months or more, and you're starting to add to it, right? So not sure whether you started adding at 50 or whether you started adding in the mid-40s. But looking at it now, you can see that when it comes back to 50, it's going to have work to do. And it's going to have to show that it's ready to move past that, like it was not earlier in July, right? When it was right after its earnings report. So it's got a very important test coming up. If it fails that test, it's going to come back down. And it's either going to stop at 47 again, or it's going to make its way down to this level here, around 45. And then from there, that should be another substantial level of support. If it falters there, then it's probably going to go down all the way to 42, right? So if you're looking to scale in, and if you're looking to average down, you have your levels, right? Now, where can it move? From here to 12 months, that's a long time to go, right? So I can't, uh, it can go anywhere from here to the 60s, depending on earnings reports over the next 2 or 3 quarters. But in the short term, if it can clear 50, it's going to start to make its way into this gap. And then from there, it's got a long way to go to fill that gap. And probably something it won't be able to fill until its next earnings report, unless there's a significant change in character in the chart, which at the moment we're not really seeing. But you never know. 3 months is a long time to go. And a lot can happen in 3 months. So it's going to have to eventually come up and start to work its way through that, but it's going to have work. So this is one that you're going to have to be patient with, I think. And I'm not sure that it's done dropping yet. We'll see what happens as it makes these challenges. But I think that if you want a roadmap as to how you want to scale into this, these are the levels you want to look at. You want to look at 45. You want to look at 42. And you want to see what happens now as it deals with this 50 area. And like I said, I know for those that maybe don't know, Sam and I, we've had a good relationship for a long time, trading-wise and mentoring-wise, and I've helped him learn a lot of different techniques. One of them being covered call strategies. So Sam, if you've already built up enough of a position where you could sell covered calls against it, then you want to look at this gap as a potential area to maybe lower your average cost, and possibly even the $50 level as a level somewhere in here where you could start to lower your average cost on it. And clearly, as it starts to move into the gap, particularly here around the 53 to 54 level, as another area where you maybe want to start to average down, lower your average cost by maybe selling a call and taking some profit as it kind of struggles with some of these levels. Okay. All right, so that covers it. Hope you guys had a good day today and you got value out of this. Like I said, if you like what you saw here, you can always follow me at Twitter, at StockDarts. And like I said, I'm more than happy to answer questions on there. I don't clutter your feed with a lot of posts. I'm not the kind of person that really shares a lot. Usually, if I type something out, it's either telling you when I'm going to have a free webinar, or when I'm posting up an article, or if I find something that's important to really mention. I'm not the kind of guy that tweets 10 times a day, so it's not going to clutter your feed. If you like what you see and you want to look at more of these types of trades, you can always visit me at patreon.com/stockdarts. Even the subscription stuff, a lot of times it comes free after 2 or 3 days. So if you want to go ahead and examine how we've been trading this market, it's all up there for you guys, and you're more than happy to go through there. There's a lot of information out there you can see on just how I like to trade and how I go ahead and trade the markets based off of whatever my thoughts are on the market environment that we come up with on these Wednesdays. Hope you guys have a good rest of this week, and we will meet again next Wednesday.